Hi guys, so let's now have a look at international trade. It's had a bit of a bad rap in recent times, so we're going to do a full analysis of it with a diagram and see what we think. Okay, so let's take a look. First up, you can exploit a country's comparative advantage by using international trade. That is, you can actually ensure that whatever they can do at least opportunity cost to themselves, then they are actually focusing production on that. That enables them to specialise in the production of those goods or services, and of course that's likely to be very good news in terms of trade. Moreover, you can also, as a result of that specialisation, exploit economies of scale. So that means that the firms working within those given sectors will be able to employ and invest in specialist capital machinery which is necessary for the production of those goods or services. Moreover, they'd be able to ensure that they had the right skills for the labour force, and they develop those managerial economies of scale. And there's also going to be other economies of scale available to them, including financial economies of scale as a result of that specialisation. Okay, so there's various points that we see in relation to that. Now, there's also the prospect of increased competition, and that, of course, improves the supply side of the global economy and helps to reduce prices overall. So when it comes to laptop prices, white goods generally, the price of those goods has really come down over the last sort of 10 to 15 years as China has been able to actually increase production of those at very, very little cost, and thus we see lower prices in Western markets for those goods. Okay, number 4, the quality of goods and services can also improve as well because of this specialisation, and because they invest in specialist transportation and so on. Then it means you get a better final product ultimately. And number 5, you can have increased employment as well. So increased employment can actually take place as a result of more jobs being available thanks to trade. Okay, what are the downsides then? Well, first up, we can see that for LEDCs, their industries may find it very difficult to actually compete against some of the most efficient firms globally, and those are likely to be those multinational corporations, of course. So there you may have an infant industry, say for the likes of Nigeria, which is trying to develop its manufacturing export sector, and it's really struggling to compete with multinational corporations that can actually produce at much lower costs. Okay, number 2, you can have over-specialisation as well. Over-specialisation may result in, for LEDCs, primary product dependency, and that primary product dependency may end up meaning that they never actually move up the value-added chain, and they, further to that, will experience what's known as the Prebisch-Singer hypothesis, which we'll look at later in the course, where you see declining terms of trade because of the differences in the income elasticities of demand for primary goods versus the goods that will be imported, which will tend to be consumer goods, which therefore have high income elasticities of demand, whereas goods like oil have very weak income elasticities of demand, even though they're slightly positive. Okay, again, that's something for another time if you haven't looked at that yet. Number 3, there can be a painful structural adjustment process. We've seen this particularly within MEDC economies. So this structural adjustment can be very, very difficult, of course. Now, that often results in large structural unemployment within manufacturing sectors. We've certainly had it here in the UK, but also in the US, and that then promotes calls for protectionism, i.e. putting barriers and impediments in the way to actually prevent trade. Okay, so let's take a look at a diagram here. Now, you can see that I've just drawn out a very straightforward demand and supply diagram. Now, what we're going to consider, however, though, we're going to consider this to be the UK market in effect, and we've got the domestic supply and the domestic demand. So this is very much a scenario playing through right here, which we may see if the UK did not engage in international trade. Okay, so we can see that we end up with the price of P1 and a equilibrium quantity demanded level of Q1 there, okay? So as soon as we actually think about trading though internationally, that we want to buy in goods from other areas, perhaps we might be looking at fruit or something like that as this instance here, then we're likely to see a supply curve which looks something like this. Because the supply for the world, there's many different producers of this given good, it's likely to be perfectly elastic because there's so many alternative substitute products available, and we only need so many bananas, so many apples, so many oranges, and so on. And we don't mind whether we get our oranges from Spain or perhaps Italy or Croatia, and so on. So what we can therefore see is that there is some disruption to the market here. We can highlight each of these points. Let's put down Q2 there, and then we're going to have Q3 right out here. Okay, so what's interesting about this now is if the UK economy actually engages in international trade, and we're assuming that there are no impediments in the way, no protectionism in the way here, then we can see that supply equals demand right out here. And as a consequence of that, we can see that the actual increase in consumer surplus is absolutely huge. So we were here, but now all of these consumers can suddenly actually benefit from that given good, which is available so much more cheaply. They would have liked to have bought it, but they couldn't buy it at the sort of price they could afford or would represent real marginal benefit for them or utility. Okay, so we can see a big increase taking place there. But what's also interesting is the actual domestic level of supply. So domestic producers were previously producing right out to Q1, but now we can see only the most competitive, the most efficient domestic producers are continuing to actually produce goods, and so we can see that from 0 through to Q2.